Hello, everybody, and welcome back to the Prosperity Trading System. Today, we're going to cover when to buy and when to sell. So, before, the topics that we covered were about understanding charts and understanding candlesticks. Now, we're going to dive a little bit deeper into how to use this information to know when you're supposed to buy stocks or options or futures, and when you're supposed to sell them, and how to recognize the difference between the two. When can you tell? The truth is, you're supposed to know what you're trading, how you're trading, what direction you're trading before you buy or before you sell. And in order to make this easier, you're going to need a guide. And what I mean a guide is you essentially need a GPS that tells you how the market is going to work and what to do during the market. Most of the traders fail because they do not have a successful way of looking at the market, and because they lack that overall guide of how the market works, they end up guessing on what to do. Here's your GPS system. This is an overall GPS system of how the market works exactly. It works in 4 different phases. And if you understand these phases and you understand a complete market cycle, this will make life 10,000 times easier for you if you're a trader. Not being able to associate when these times are happening and not being able to tell in a real life scenario when these are occurring means that you don't understand when you're supposed to be trading. And if you do not understand when you're supposed to be trading, you're always going to be caught on the wrong side of the trade. These are broken up into 4 phases. Each of these phases have a position where you're supposed to be exiting those positions and setting up each single time. So we're never going to trade in the avoid zones, and we're never going to actually start moving until we get to what's called a B buy setup. And this only happens by understanding what phase of the market you're in. The 4 phases are broken down into accumulation, markup, distribution, and decline. Accumulation is when the signals for reversal come into play. So accumulation, during these phases, you'll have what's called major reversal patterns. The major reversal patterns you'll be familiar with might be something like a head and shoulders or an inverse head and shoulders or a double bottom or a double top. These major reversal patterns or major inversion patterns are always a signal on a larger institutional basis that the market is going to shift from one cycle to the next. And when that cycle occurs, then there's going to be a major shift in the way the market moves. The GPS has 4 key areas, which we were just talking about: accumulation phase, the markup phase, the distribution phase, and the decline phase. This works for everything, whether you're trading stocks, options, Forex, if you're trading Bitcoin, if you're trading crypto. It does not matter what you're trading. It only matters that you understand how the GPS works. So you can trade any commodity, any derivative, anything, as long as you know how to use the system. The issue with a lot of people who trade certain things, such as fair value gaps or order blocks or things of that nature, or whatever it may be, it only works within a certain time frame and a certain condition, unless you know the overall cycle of the market and you can apply that type of trading style to the condition that you're currently in. Otherwise, it becomes quite a dangerous game. Let's break down the phases. So accumulation, or phase one. This is also known as anticipation phase or accumulation and data collection phase. This is when a reversal pattern will be like the bat signal to let everybody know that this is typically between the mid to late phase where a major reversal pattern will form. Once this starts to form, it will give all major institutions, banks, hedge funds an indication that it's time to choose a direction in the market. Now, what you'll notice is if you look to the side here, I'm not sure if how familiar you are with the process of a pattern forming like a double bottom, but you'll see an accumulation phase. In early phase, they have a double bottom that forms. In the mid phase, another double bottom that forms. And in the late phase, the last double bottom that forms. And when you have the completion of a double bottom that forms in a late phase, that phase will always play out on a Fibonacci up to 400%. And we will see these things later when I start showing you how to use indicators and actually how to use tools in order to mark out and see that these things are not random. They're not magical. They come out and they play out to very particular numbers at a very particular time. The only difference is whether or not you see these numbers, you know these patterns, and you know how to read your GPS. Once the late phases happen, we're talking late accumulation, phase 3 portion of accumulation, or phase 2 portion of accumulation. If you're somebody who's a swing trader or an investor, this will be your time to enter the market. Why? Because once you enter this market, you do not plan on looking back. And when I say investor or long term trader, this is something that you're planning to hold for 5 to 10 years. So let's say, for example, you're very big on XRP, or you're very big on Bitcoin, or you're very big on a company like Apple. This can also be done in up and coming companies, companies that are quite new, that are still in their accumulation phase before markup occurs, or after their initial IPO, because typically we want to wait for an IPO because their full markup phase has not completed, which means that when people usually enter IPOs within the first 6 months to a year, those are the people who actually either lose the most money if they were not early investors, or they end up having to hold a terrible position for years to come. Now, the markup phase, or phase two, this is when a stock develops a clear upward trajectory in a pattern with a direction. This is where all buy opportunities exist. This problem is something that occurs when people start forming the idea that, hey, this is let's buy the dip, let's buy the dip, let's buy the dip. So, like, you'll notice that during COVID and things of that nature, there were a lot of people who were like, let's buy the dip, let's buy the dip. That worked perfectly fine during that phase of buying because that was a clear markup phase. So, because after COVID occurred and the market had a horrendous pullback, after that, we ended up having a very strong markup phase. So, imagine this area right here at 2.1 was our initial area of COVID, except that was extended further down. And with that horrendous drop down, followed by this entire markup phase that was put on by government support, that market phase led to everyone being able to say, hey, they're a market guru, they're amazing at trading, this is what I did to make $1 million. Basically, people were just throwing the kitchen sink at the stock market, knowing that it couldn't really go down, but having no real idea of why that was occurring, not knowing what phase they were in, and not understanding how market cycles work. Now, within a distribution phase is where large companies start to hedge or trim their positions. Why? Because this means that if you are a long term buyer, or you are a person who was interested in making positions from the upside, this is where you start to shave your positions. Now, because it's impossible to predict the very tippy top of something, it is difficult to see exactly when to exit. So what happens is major corporations start to offset their positions. Imagine you bought 100,000 shares as a major corporation, or millions of dollars worth of shares. And then what happens is you cannot offload all of your shares at one time. Otherwise, you would start to pull the market down, which means that the rest of your position starts to lose money. So what happens is you enter and you exit, you enter and you exit over and over again in order to make sure that you have the ability to exit your position safely. Once you start to exit your position safely during these major reversal patterns, now you start to exit your long positions and start to enter your short positions. This GPS is telling you it's time to start exit. Your exit is coming up. You should get out of your short positions and you should start entering you should get out of your long positions and start entering your short positions. Now, the decline phase, also known as the bear market phase, also has the same type of setup where we have an anticipation, we precipitate the idea that we need to actually exit. You have the ability to buy to cover, and you have the ability to avoid entry points. Now, what happens here is if you're a short seller or you're interested in an area to be short, every position that happens during anticipation is a setup to you for selling to the short side. Now, this is difficult if you're a person who does not like to short, or you're very biased to buying the market only in the upward position. But this is where you close things that you bought and start to enter a short position and you get ready to sell. Now, I'd like to show you how to see this on a real chart. On a real chart, this is a complete market cycle. A complete market cycle has a valley position, a peak position, and another valley position. A valley plus a peak plus a valley enters an entire market cycle. So when that occurs, what happens is you complete the accumulation phase. This accumulation phase ended with a double bottom. Once that double bottom has completed, we go from phase one, or phase A here, which is your accumulation phase, into phase B, which is your markup phase, into phase C, which is the distribution phase, and then into phase D, which is your decline phase. This splits the market into two halves. The left side, which means that during the left side of the position of the market cycle, you're going up towards the top of your bell curve, which means that this is the side that you buy. On the right side of the bell curve, this is going to be your positions to start selling, which means that every low position is a B buy setup, which means that if you were to enter the market here, as again, let's say you did it based on a support and resistance area, this green line indicating your support zone, that means that every single time you entered and you had a stop loss below the low, 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 you were able to hold these as swing positions and you never would have gotten stopped out of your position. And once this occurs, this reversal pattern would have completed itself to the cycle to the upside. Now what you see here is a shoulder, a head, a shoulder. Or you can say it from here, a shoulder, a head, and a shoulder. This would indicate here's a head and shoulders pattern, here's a head and shoulders pattern. This is an indication of a reversal pattern. These major reversal patterns are only going to occur in the accumulation phase of the market and the distribution phase of the market. Accumulation phase is the start of a markup phase, which means this is our buying cycle. And then once the accumulation phase is completed and the markup phase is completed, then you have the distribution phase where the market seems to move sideways. You'll notice this area where the market is not going up any higher, but it's not falling down any lower. And it stays in this range. You'll notice the blue line is just kind of sitting here before it actually starts to fall. So again, this is our markup phase as we follow the blue line up. We sit sideways for a little bit as we're in our distribution phase. And then finally the blue line starts to fall, and this is our decline phase. Knowing this is a key indication of when to buy, when to sell, when to hold, and when to be able to make profit in any type of position you are, whether again you're an options trader, a forex trader, someone who's very interested in cryptocurrency. This is a way to make profit on a regular basis. So for example, a prime example now is, depending on when you're watching this video, let's say for now, this is 2025 in October, there is a large drop in the price of SPY. So that large drop in the price of SPY would be an indication of the start of the distribution phase. And that distribution phase will probably trigger a pullback on SPY, a push up on SPY, followed by an actual decline. If that's the case, and you're understanding how this market works, you're able to place your position to where you're able to be short and you're able to make profit as the market goes down. It doesn't matter the direction of the market. It doesn't matter your sentiment of the market. It doesn't matter your feelings of the market. It matters the GPS of the market. The GPS will tell you where to go, and as long as you listen to the GPS, you will be profitable. With that being said, occasionally the stock market goes down dramatically and creates a short window for opportunity to buy stocks at a very deep discount. However, to act upon it, you need to be prepared before it happens. If you're not prepared, you will not be able to seize the opportunity. And if you do not understand how to read your GPS, you will not be in a position to make profit. Most of the people who teach online usually teach a strategy, or they usually teach some type of get rich quick scheme, and they do not teach actual skill sets. Learn the language, understand the charts, understand the market cycles and how they move. Once you take that information together and you accumulate it all together, then you're able to comply and compel all this information and compound that information into a proper trading plan and a trading system that works for you. This system is universal. The system works with any market. The system works continually, whether the market is going up or down. We will continue to go all over these cycles, and we'll continue to drill this information, and then we'll also make the process of moving to live charts so that you can see what it looks like as the markets are progressing and as the markets are moving. But we'll move from step by step to being a novice trader, to being a professional trader, to being an institutional trader. And I will lead you along that process as long as you feel free to continue to join us. So, wishing you all the prosperity in the world. I will see you in the next class.